Okay, let's unpack this. Welcome to the deep dive. We're here to pull out the key insights and knowledge just for you. Today, we're looking at something pretty fascinating. It's where crypto, specifically Ethereum, bumps up against the more traditional world of Wall Street finance. Yeah, our mission here is to really explore this major strategy that's unfolding. It's all about changing how big institutional investors look at Ethereum, the end game, trying to make ETH, a legitimate asset class for those really large portfolios. And here's where it gets really interesting right off the bat. Our sources point to something quite striking. Corporate Ethereum holdings have ballooned to around $22 billion. That's a massive number. What does that scale, that accumulation by corporations, actually tell us about the market?
Well, it tells us quite a bit. What's fascinating is how these holdings aren't just numbers on a page. They genuinely influence the asset's mechanics. That $22 billion gives these corporate holders significant sway over the token supply dynamics.
Whoa, so?
Think about it. When such a large chunk of ETH is held, maybe long-term, by just a few big players, it directly takes it out of active circulation. Less supply available for trading. That can potentially reduce liquidity, maybe make prices move more sharply on big trades.
Okay. Fewer sellers, potentially.
Exactly. But it also signals, long-term belief in the asset, conviction, and that itself can contribute to this perception of stability, even if it impacts short-term trading dynamics.
Right. So with that kind of money already parked in ETH by corporations, it makes sense that the industry wants to build on that. Which brings us to this big strategy. Leading crypto firms pushing a combined $6 billion Ethereum Treasury plan. Is that $6 billion just a number they picked? Or is there a specific reason for that amount? And why push this now?
Yeah, it's definitely not random. If you connect this to the bigger picture, it's less about the exact number and more about legitimization, deep legitimization. Sources suggest the $6 billion is seen as a kind of critical mass.
Critical mass for what, exactly?
To provide enough liquidity and market depth. Enough to make ETH look like a properly tradable asset for those really large institutional funds. It's possibly pegged to, say, a typical percentage allocation they might consider for dipping their toes into a new asset class.
Like signaling, we can handle your size.
Precisely. It shows Ethereum can absorb significant capital flowing in and out without causing, wild price swings. And the timing, it feels crucial. Institutional interest in digital assets is growing, but they haven't really had a clear, structured way to invest at scale. This aims to provide that path.
Okay, so legitimacy is the goal. But Wall Street is famously risk-averse. How do these crypto firms actually plan to get that buy-in? Sources mention using centralized Treasury holdings to create institutional confidence and legitimacy.
Yeah.
What are centralized holdings in this crypto context? It sounds a bit counterintuitive for a decentralized asset, doesn't it? How does that build trust with traditional finance?
That really hits on a key question, doesn't it? What does Wall Street need to see before they get comfortable? Essentially, centralized Treasury holdings here means setting up a more managed, maybe even regulated, pool of Ethereum. Think of it less like thousands of individual wallets and more like a dedicated fund or trust structure.
So more like something they already understand.
Exactly. It provides a clearer chain of custody, maybe involves regulated custodians, perhaps even structured products like ETFs eventually. It offers a framework that traditional finance understands, relies on. Oversight, governance, predictability.
Okay.
It directly addresses their need for, stability and clear accountability. It's about presenting Ethereum holdings in a package that feels familiar and, frankly, safer to them than just raw, decentralized holdings.
So it's about packaging ETH to look and feel more like the traditional assets they're used to managing.
Got it. Let's pull back to that main ambition then. Making ETH a financial asset class suitable for large-scale portfolios. If this whole strategy actually works, what are the implications? What does this mean for digital assets fitting into the wider financial world?
Oh, it could be genuinely transformative. I mean, this whole initiative is designed to bridge a pretty major gap. It's about moving Ethereum away from being seen just as a speculative crypto coin by attracting that big institutional money and offering this more structured, centralized treasury approach.
Yeah.
The goal is for Ethereum to really evolve, to become a recognized treasury asset, something that could sit right alongside bonds or equities or commodities in a major institutional portfolio.
Wow. So not just an alternative investment anymore.
Potentially, yes. It fundamentally changes its role and how it's perceived in the global financial system. It would signal real maturation of the crypto market, digital assets becoming integrated, not just outliers.
Okay, quite a shift. So just to quickly recap this deep dive for everyone listening, we've touched on the frankly enormous corporate ETH holdings already out there, that $22 billion figure. Then there's this ambitious $6 billion strategy from crypto firms to really court Wall Street. And the key mechanism seems to be using these centralized treasury holdings to build that crucial institutional confidence. So here's something for you to think about. What would it actually mean for the definition of a treasury asset itself if something like Ethereum does become a standard holding for big corporations and funds? How might that fundamentally reshape traditional finance over the next few years? It's definitely a fascinating possibility, isn't it? Keep digging into these evolving financial frontiers.